Hello, everybody. This is Douglas Auclair, known online as Joff. I'm the owner of the Pivot Technologies LLC, which is in charge of the newly founded Pivot Protocol. What I'm going to be doing today is talking about what the Pivot Protocol is, what pivot arbitrage is, and how you as an investor can participate and benefit from the technologies in pivot arbitrage. Okay, so let's get to it. Okay, so first let's talk about what pivot arbitrage is. And the first thing that you have to grasp is to understand that pivot arbitrage is different significantly from traditional arbitrage. With traditional arbitrage, what you do is you buy $10,000 worth of ETH on one exchange and then go to another exchange and sell that ETH back for $10,010. And that all occurs in one transaction. And you can use flash loans to facilitate that exchange. But that's how traditional arbitrage occurs. And with Forex, you arbitrage money by arbitrage between the current value of, say, the US dollar versus the British pound versus the expected value. And how arbitrage benefits a market is that it drives the price toward its fair value. So if the price of, say, ETH is high, for example, you would set as an arbiter, you would sell ETH and bring the price down. If the price of ETH were low, then you would buy ETH and that would drive the price up. So the arbiter in a ecosystem helps to keep the price at fair market value. The thing about traditional arbitrage is that usually they're for a large amount of money. So usually whales or large investors participate in this. Usually they all occur in one transactions using flash loans and a threaded transaction between one exchange and another exchange, which may require some programming or smart contracts. So it also requires an investor with programming experience and a savvy investor at that. There's also risk entailed with arbitrage should that you buy the ETH on one exchange and the other exchange during that transaction, the price of ETH goes way down, then your arbitrage opportunity goes away and you're left holding the asset that you wanted to do the arbitrage with. That's traditional arbitrage. It's high-paced. It has very, very small profit margins, usually of 0.25%, if that. You're putting a lot of money on the table at risk. Pivot arbitrage, which is my creation, is quite a different thing. With pivot arbitrage, what I noticed is that there is the ratio between two cryptocurrencies, which is the blue line here, and the ratio here is between Bitcoin and ETH. And then there is the EMA 20. The EMA is the exponential moving average, which is an average that moves over time with the currency. So you see the average moving over time with the currency. The exponential average of 20 days moves more closely with the change in price. The red line, which is the simple moving average over 100 days, moves much more ponderously, much more slowly. But taking the exponential moving average, you see there are points where the ratio is below the exponential moving average, and you see that there are times when the ratio is above the exponential moving average. Let's take a look at an example of how to make pivot arbitrage work. If we're looking at, for example, arbitrage, pivot arbitrage between Bitcoin and PAXG, or the Paxos Gold token, you see that there are points on the curve, that wildly oscillating points, where the Bitcoin versus the PAXG ratio is below the EMA 20, the exponential moving average, and there are points where it is above the exponential moving average. What pivot arbitrage does is compute based upon the ratio versus the exponential moving average and creates a call, either buy or sell. A buy call is to say buy Bitcoin by selling PAX-G. And when would you do that? When the price of Bitcoin is low compared to the price of PAX-G, you find that the ratio is lower than the exponential moving average. And so that would generate a buy Bitcoin call with PAX-G. Conversely, when the ratio is above the exponential moving average, then Bitcoin's price is high compared to the price of PAX-G or gold. And so that would generate a sell order to sell Bitcoin for PAX-G. But then what happens? When you buy Bitcoin when the price of Bitcoin is low, and you sell Bitcoin when the price of Bitcoin is high, then what you've done is by buying Bitcoin with PAX-G, you are, in fact, the opposite, selling PAX-G for Bitcoin. So you are creating a pivot arbitrage for PAX-G using Bitcoin as the pivot token. So you sold the PAX-G here, and then when it goes back up here, you buy back the PAX-G, but lo and behold, you have more PAX-G and you have the same amount of Bitcoin that you started out with. And so by simply selling PAX-G low and then buying it back when Bitcoin price is high comparatively, you are using Bitcoin as a pivot token to increase the amount of PAX-G that you have. Conversely, if you are doing pivot arbitrage for Bitcoin, here the price of Bitcoin is high, so you sell Bitcoin for PAX-G. Here the price of Bitcoin is low compared to PAX-G, so you buy Bitcoin with PAX-G. So here you sell the Bitcoin, and then here you buy it back, and lo and behold, you have more Bitcoin with the same amount of PAX-G. If you look at these two sets of arbitrage, which is 1, 2, 3, 4 trades, but two arbitrage, then you have more PAX-G with the same amount of Bitcoin, and then more Bitcoin with the same amount of more PAX-G. Pivot arbitrage builds, in this particular case, both your Bitcoin and your PAX-G bags and it's a monotonically increasing amount of both Bitcoin and PAX-G. This is very different than liquidity pools. With liquidity pools, you supply both Bitcoin and PAX-G to a Bitcoin PAX-G liquidity pool. But as the price of Bitcoin goes up versus PAX-G, you have less Bitcoin and more PAX-G. And as the price of PAX-G goes up compared to Bitcoin, you have more PAX-G than you have Bitcoin. You have more Bitcoin and less PAX-G as the price of PAX-G goes up. That type of investment into a liquidity pool is called the XY equals K liquidity pool, meaning that it's an automatically balanced liquidity pool. So you benefit in neither case as the price fluctuates with a liquidity pool. For a liquidity pool, you're supplying liquidity into the pool, usually for a DEX to exchange one token for the other. And because you've supplied that liquidity, because the trades go through your supplied liquidity, you get a very small portion of that trade. But you don't really benefit from the oscillation of the prices between the tokens themselves. In fact, you get the opposite effect in that when the price of one or the other varies, the value of your investments is less in a liquidity pool as compared to if you just held them as separate assets in your wallet. So that's a caution with liquidity pools. Liquidity pools, you supply liquidity, you benefit from the trades and the exchange, but the liquidity pools are automatically balanced and not usually toward your favor unless you are a very savvy investor and you know what you're doing by investing into a liquidity pool to take advantage of a price difference of one token to the other. But you've got to know what you're doing when you're doing that investment into liquidity pools. Conversely, the formulation for pivot arbitration is quite different. And that is, you see here the liquidity pool, the equation. For pivot arbitration, you have the additive feature of x at times t plus y at times t equals the pool at times t, which means that your Bitcoin that you've invested and your gold that's your investment are not dependent upon each other. When one goes up, that does not necessitate the other one going down. When the other goes up, it does not necessitate that the first one go down. These two are additive as opposed to with the liquidity pool where they're multiplicative and dependent upon one depends upon the other to maintain that constant pool value. With the pivot arbitrage, as the pool grows, your assets grow. As your asset grows, the pools grow, and one asset is not dependent upon the other. So pivot arbitrage in a nutshell. Now, one more point here is that look at the scale of time that these arbitrage occurs. If you're doing an arbitrage of PAX-G with using Bitcoin as the pivot token, you're going over almost half a month, if not more. Yeah, you're almost going 2/3 of a month to do one pivot arbitrage. Let's look at the other side. You're starting here at the end of the month, and you're going here towards sort of the beginning of the month, but that's about a week. So a single pivot arbitrage transaction of the open the pivot to the close the pivot is in this case a week, not a microsecond. It's a week. So that means that one, you don't have to be staring at your screen, your stock screens or your cryptocurrency screens all the time in order to get the advantage of the arbitrage. What you're doing is you're basing this off the EMA 20, which is a 20-day period. So you can do the arbitrage once per day, and you're done for the day. A very much different level of stress than traditional arbitrage. Also, pivot arbitrage works with whatever size that your pool is. You don't need to put in $10,000 to make $10 in a transaction. And so traditional arbitrage, they do hundreds of arbitrage in a day in order to be profitable. But with pivot arbitrage, if I may show you, I did on the Terra blockchain when I was trading with Terra-based assets. I did 1, 2, 3.5 arbitrage, and nearly from 100% to 150%. So that's nearly a 50% gain by using 3 arbitrage. Think about that, a 50% gain in my portfolio with 3 arbitrage, which is 6 trades in total over a period of 2 to 3 months. 50% gain in the portfolio over 2 to 3 months with 6 trades. Pivot arbitrage is very, very different than traditional arbitrage. Do not think about it. Do not think about pivot arbitrage like traditional arbitrage. It is not frenetic. It is not high-paced. It is building cumulative wealth at a measured pace. Okay, so that's pivot arbitrage. Let's talk about the protocol. The protocol. So the protocol is composed of four components. You have your pivot pool where the pivot arbitrage occurs. You have the treasury where some of the gains from the pivot arbitrage goes to. You have an echo pool for building liquidity within the protocol, which I'll touch base on later. And then you have you as the investor. Let's look at the interrelations between these sets. So the pivot pool contains the tokens that you're building with pivot arbitrage. The echo pool is an echo of the pivot pool. So if you have a pivot pool of Bitcoin and Ethereum, the echo pool would be called the Bitcoin Ethereum echo pool. It would also include the protocol token. In this case, it's the undead token. And so pivot arbitrage occurs in this pool amongst the three tokens. Well, what is normally the direction going to be? Normally, the direction is because Bitcoin is more valuable than the undead token, or Ethereum is more valuable, then token flow is going to be Bitcoin buys the undead token, Ethereum buys the undead token. The price of the undead token rises, doubles, triples, and then you have the opposite arbitrage effect occurring where now you're buying Bitcoin and Ethereum with undead token worth 2, 3, 4 times its past value when you bought it with the Bitcoin and Ethereum. The point of the echo pool is one, as you buy the undead token, you're creating more undead tokens in the protocol, which go to the treasury. That's one point. The other point is to drive up the value of the protocol token. We do that by buying the token, creating demand for it, by buying it with blue chip assets such as Bitcoin and Ethereum. That drives up the price of the protocol token. The other way that you drive up the price of the protocol token is that you, as the investor, invest into the pivot protocol by using the protocol token only. So your only access into the protocol token with the protocol up and running is by purchasing undead tokens and then investing it into the particular pool or into the treasury in which you wish to invest in. This also drives up the price of the protocol token, which goes into the treasury and goes into the echo pools, which when the treasury gets more funding from profits from the pivot pools and profits from the echo pools, creates a new pivot pools with new echo pools, which profit and then send it to the profit to the treasury, send the profit to the investor, which allows the treasury to grow. With the growth of the treasury, we can fund a new pivot pool. So we may start with the Bitcoin and Ethereum pivot pool, the OG, the old guard. But then we may also want to do a Bitcoin versus PAX-G, a Bitcoin versus gold pivot pool. Or we may want to go into the Binance Smart Chain and do a Binance versus Litecoin versus Link, for example. Or we may wish to go into Avalanche and do pivot arbitrage with the AVAX token. All of these will be funded from the growth we accumulate in the treasury. So as the investor invests into the pivot pool and gains are made into the pivot pool, the pivot pool refunds itself with some of the growth, funds back the investor, not in undead tokens, which the investor invested with, but with Bitcoin and Ethereum. Why? Because the pivots occur between Bitcoin and Ethereum. You gain Bitcoin, you gain Ethereum. So the yields will be in Bitcoin and Ethereum. You invest undead, your yields are Bitcoin and Ethereum. You get that back as yields. The protocol refunds the pool with some of its gain to grow the size of the pool over time. So the pool becomes bigger, your yields become bigger. This refunding the pool has a secondary effect of growing your returns. The pool's gains also go to fund the echo pool. The echo pool starts out with undead tokens only and is questioned until it gets funding from the pivot pool. Then Bitcoin and Ethereum trickle into the echo pool. Pivot arbitrage occurs here, growing more undead tokens, which refund itself, and also fund any investor who invests into an echo pool, and also funds the treasury with any pivot arbitrage gains. So a Bitcoin, Ethereum echo pool will have gains of Bitcoin, will have gains of Ethereum, and will have gains of undead based upon pivot arbitrage of each token. That is and also the investor, you may invest into the treasury itself. The treasury is a safe store. There's no trades going on in the treasury. The treasury receives gains from the pivot pools and it receives gains from the echo pools. And then investors into the treasury get a portion of those gains on whatever the gains are. So if a pivot arbitrage on Bitcoin, when there's a gain on that pivot arbitrage, some of it trickles into the treasury, and some of that gain goes to all investors who invest into the treasury. The caveat with the treasury is it's a safe place. So the gains are going to be much more rapidly returned to you in your investment in pivot pools, since echo pools are 1/10 the size of pivot pools and only grow as gains in the pivot pool occur. Then it's going to take a more time for gains to be realized in the echo pool, and those gains are going to be minuscule compared to the gains that are happening in the pivot pool. The heartbeat of the pivot protocol is the pivot pool. The support of the pivot pool and how liquidity is grown is in the echo pool. The safe store of the protocol is the treasury. You, the investor, fund each of these by using the protocol token to invest into each. Now let's do, so you see how to invest in the pivot protocol by either the pool or the echo pool or into the treasury using the standard approach by using the protocol token. The thing is, we're starting up right now. So here is a one-time opportunity for new investors. If you want to invest into this approach of pivot arbitrage, now why would you want to do that? Say you're sitting on, and I have colleagues who are sitting on a lot of Bitcoin. Take some of that Bitcoin, invest it into the pivot protocol, and convert that Bitcoin into income. Same reason with Ethereum or with BNB or with PaxG or Avox or Link or Litecoin. Whatever the pivot pool is, if you have a bag of that token and it's just sitting there, you can stake it into your blockchain like Ethereum and make 3%. Pivot arbitrage is at a whole different level. Recall that this is a 50% growth in 2 months. It is not a 3% per annum growth. Even though it took 6 trades over those 2 months to get that 50% growth. So the growth is not occurring at every second. Please be aware of that. But the growth is occurring at a much higher and much more measured pace than if you simply stake your assets into your blockchain. So if you want to stake your Ethereum into the blockchain, then you can get your 3% return, and that's that. That's totally fine. Same with traditional arbitrage. If you want to do traditional arbitrage with your Ethereum, that's totally fine. But if you want to grow a set of bags over time, and you want that managed so that you don't have to do the calculations, you don't have to do the trades. The pivot protocol is there to do that work. It then measures the work, the output, and then outputs the gains as yields to you, the investor. You invest with undead tokens, you get your yields in whichever pivot pool that you invest in. Say Bitcoin with Ethereum, you would get Bitcoin and Ethereum yields from your undead investment. But since we're starting up as a protocol, there is the rare opportunity that we need to establish these pivot pools. So if you have Bitcoin or you have Ethereum or you have other pools that I have are the Bitcoin, PaxG, and BNB pool. Another pool that I'm creating is the BNB, Litecoin, and Link pool. And of course, the OG, which is, so here's the BNB, Litecoin, and Link pool. And the OG, that is the Bitcoin and Ethereum pivot pool. If you have any of these kinds of tokens and you wish to invest into the protocol as a first mover, then instead of investing the undead token, which has a high price variability, you can invest your Bitcoin or your Ethereum into the pool and make gains on the pivot arbitrage with the arbitrage gains. So say you invest Bitcoin into the Bitcoin and Ethereum pool, you would get gains in Bitcoin and you would get gains in Ethereum. After the protocol is established and the pools are established, your way to invest into the protocol is by using the undead token. And so you would invest into an established pool such as Bitcoin versus Ethereum with your undead tokens. That undead token set would be matched by a reserve, which would translate those undead tokens into Bitcoin or Ethereum based upon the favorable trade at the time. And based upon what percentage size your investment is compared to the entire investment pool, you get yields in Bitcoin and Ethereum based upon the amount of undead tokens that you invested. That's when the pools are established, up and running, and going already. Now, the Pivot protocol is looking for investors with assets and Bitcoin, Ethereum, BNB, Litecoin, Link, and PaxG. If you have these tokens, they're in your wallet, they're on your ledger, and they're sitting there, not making profitability and yield for you, then go ahead and invest with our protocol. Those tokens will be put into the pivot arbitrage token, into the pivot arbitrage pools, and you will start to get yields based upon the pivots upon those tokens. Thank you very much.